Oh, wow.
Yeah,
between 50 and 60.
yeah, and we have about 1,800 in our group that we
Wow.
shoot this out to. So no pressure.
Yeah, that's good. Is that all rev share? Or is that a coaching group?
No, this is we have people from all brokerages here.
Nice.
So yep, yep.
Coaching.
So people just come here to learn tech
I love it. I love it. That's great. That's what I was
and
going.
learn how to never pay the IRS again. Hi
Uh,
guys, good morning.
Okay, I'm gonna
Let me
press
give you
record. Did you do live? I didn't see it. Oh
I'm
yeah, it
live.
is. I
I'm
see
live.
it. I see it.
Okay.
Okay, let me
All
hit
right.
record.
Very good. So how are you guys doing? Everybody doing good? Awesome. Camera's on, unless you're naked. You know the rules. All right. So I'm super excited about today. I know we usually talk about tech, which is my jam, but I met Jared at Puerto Rico. Shocker, right? I've been bringing everybody from Puerto Rico onto the call. And these are my new friends, and they're just freaking brilliant. So I was an REO agent, back in the day, and one of my best years ever, and I owed the IRS $50,000. So when Jared said something about never paying the IRS again, it really hit home, right? Because I don't know if you guys know this, but you can't make a payment plan unless it's $25,000 or less.
mm,
Right. So I immediately had to pay $25,000 to the IRS that I didn't have. And I didn't know things, right? I did find a good accountant and I never paid them again. But it's scary and it's terrible. And especially if are a terrible saver and an amazing spender like I am. So anyway, I am going to introduce Jared Davis. He is from Richmond, Virginia, and he is just brilliant on all things when it comes to investing and saving money and obviously not paying the IRS. So thank you, Jared, for coming.
of course, of course. I appreciate you having me. So, I'd like to take a poll. Everyone here is a realtor, correct?
Hmm.
So everyone's at least a realtor already. Okay. In the chat or hands, however you want to do it, I don't really care. Put a one if you paid taxes last year, and put a two if you did not pay taxes last year. Oh, there's actually some twos, a good amount of twos. Look at that. Let's see, we've got one, two, three, four, five, six, seven, eight. Man, I'd say you guys are ahead of the curve because most of the time when I ask a room this, it's typically maybe, oh wait, hold on. Hold on. Some people said two, but I still need to file. No, no, no. I didn't mean who filed their
Ah!
taxes. That is, hold on. Let's re-clarify
That's a
here.
workaround.
I mean, who owed no taxes last year? Are we still all of these twos? Because there's a lot of twos. I'm gonna be honest with you. It's a heavy amount of twos. So all right. So some of you guys that are twos that are saying you're not paying any taxes, how are you doing it? Are you just writing off everything? What is your strategy? I'd like to hear a couple people's strategies since we have so many twos in the room before I get into this. How did you not pay taxes last year?
Right. Well, I'm gonna start just because, like I said, I found a good accountant and I've been very smart in my business planning as far as who I'm marketing to, who like when it started, remember I was Jeep girl, right? So I marketed to everybody on the trail. So guess what? All of my, off-roading was a write-off, right? All of my events I had to go to talk to more people about buying and selling, like I was the realtor, right? So I was able to write off all of my fun. Now, because I'm traveling around the country in my
Yep.
RV and my semi truck, visiting realtors, having realtor classes, coaching on the go. I can write it all off, right? So I have a really good accountant that helped me do that. However, I heard there's some better ways to do it as well. So I'm
Yeah, so
excited for
So
today.
a lot of you are saying you wrote off everything. So question for you people that wrote off everything. And again, this is going to be way less of a presentation and more of just we're going to chat today and we're going to talk through this because it could be a real complicated subject, but it really didn't have to be. So I'm just hoping to give you guys some understanding. By the way, if there's anything that you want more details on after this, you're welcome to reach out to me on Instagram. That's like my best. It's Jared Davis RE if you want to find me on Instagram. I don't mind giving out my cell number, but Instagram's nice because I can put a face to who's messaging me, right? Anybody can have my cell. I don't really care. But Jared Davis RE, if you have some questions after this. So let me ask you a question for all you guys that are just writing everything off. So your taxes, you're like, my CPA's great. He says I made $0 last year. How's that work for you when you want to go get a loan and buy something?
Not
Anybody?
great.
Not great, right? Because the reality is the bank now thinks you are poor, right? The reality is, yeah, you got around with not paying taxes, but now if you want to build wealth, if you want to buy an apartment building, if you want to buy a rental property, if you want to buy an Airbnb, if you just want a car, right? Or a house, it doesn't really go that well for you, right? I always tell people you can't have your cake and eat it too in that sense. And so many businesses, how many people are like, I'm stuffing cash in the mattress and then I'm writing off everything that does come through, and the government doesn't think that I make anything. Well, that's fine until you actually need to go tell somebody you make something. So, I saw a couple of you that put twos said you bought rental properties, right? So that's what we're going to talk about today. How many of you in the chat, again, you can put your hand up or you can throw it in the chat, are taking advantage of bonus depreciation and cost segregation now that the big beautiful bill has passed? I'd like to get a poll to see how many people are doing that. One, two, perfect. All right. Anybody else? I would expect about 3 to 5 on the call, would be my guess. So if you're already doing this and you already know this, great, no big deal. We'll try to add some more complicated layers into it if you are, but I assume that about 90% of you are not doing this right this second. So we're going to talk about it. Now, another poll. Put in the chat if you own any kind of investment real estate, not the bonus depreciation cost segs, but do you own investment real estate? We got a yes, we have a yes, we have a yes, we have a yes. No, 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 no. Okay. So look, I want to say the stat the last time I checked was about 94% of real estate agents did not own investments in real estate, which I think is absolutely insane because you guys have all the tools for it, right? Not only do you have MLS access, not only do you know the sales process, not only do you know how to run comps, but the IRS considers you guys real estate professionals. And that real estate professional guideline means everything when it comes to what we're talking about today. So if I was talking to a Zoom full of doctors, they could not take advantage of this like you guys can take advantage of this. So a lot of times you as realtors may be talking to clients and you may say, oh man, well, I've got this doctor, I've got this surgeon, I've got this lawyer, and they've got all of this money that they want to funnel into investments and they don't know what to do with it. And they're trying to get out of taxes. They can't do what you're doing unless they jump through some loopholes. But you don't have to jump a loophole because you're a realtor. If you just sell a house this year, which sets the bar pretty low for everybody on this call, right? Because if you didn't sell a house this year, then you're about as much of a realtor as a doctor, right? I mean, you sold as many houses as they did. So if you just sell a house, then the IRS considers you a real estate professional and you get to take advantage of everything that we're about to talk about. So a little background on me. I run a team out of Richmond, Virginia. We do about $100 million a year in sales. I own a mortgage company. I own a title company. I own a fix and flip company. And then I own an apartment holdings company. We have some other stuff. I own some shares in some restaurants and some real estate tech companies, some angel investing and things like that. But the big thing that we're talking about today is rental holdings and how that affects you guys. So, and this is going to be good for you dealing with your investment clients as well because I raised capital. I raised about $8 million in the last 12 months. And a lot of those people were previous clients that I was selling rental properties to that I showed a better way There are also previous clients that are in other jobs that I was able to get qualification for them as real estate professionals per the tax code. So this can be something that you guys may look at and say, okay, I can see how this can now grow my real estate side of things. So some of you guys said you're already doing this. Most of you are not. So if you didn't know this, I'm going to ask it as a question again because I really like participation more than I like talking at people. How many years? Now we'll give you a statement first. When you buy a rental property, a house, apartment, whatever it is, if it's in the residential housing sector, you get to write that property off to $0. So, question for all you realtors, if you buy a house in 5 years, 10 years, 20 years, 30 years, is it worth more money or less money than when you bought it? Way more, right? 100%. Real estate values don't go down. They went down once in all of human history since Adam and Eve, and that was 2008, 9. Outside of that, it's always gone up. Even in every single recession, depression, whatever we've had, when everything else crashes, real estate still technically creeps up, right? So real estate's always going to go up in value. Yet the government tells you that you get to write that property off to zero. So now the question for you, how many years does the government give you to write that property off from the day you buy it to zero? A couple of you said you were doing this, so I expect that at least one of two of you knows the answer. There's the one, 27 and a half years. Okay. So what that means in layman's terms, and we're going to do this as simply as possible. So if you're an expert in this today, you may listen and say, ah, well, Jared, there's some idiosyncrasies and there's some extra layer. That's fine. We don't want to confuse people today. So we're just going to keep it as simple as possible so you guys can run the gist. So barring none of the other little layers that we have to throw in there, that means that if I buy a property for 275 grand, what's my write-off every single year for 27 and a half years as a realtor? Giving y'all simple math here. This is easy math. And you can come off mute, by the way, too. You don't have to put it in the chat. You can, someone said the full amount. That's a cheat answer. No. How much per year do I get to write off? There you go. Michelle Cott Holmes, $10,000. So easy math. That's 275 grand. And again, some idiosyncrasies, you don't get to write off the land. So again, I want to keep these things simple for you so that you understand the numbers, but there's some little things here and there when you start really getting into the nitty gritty. So really they take the land off, you write off the actual property. But Michelle's dead on. 275 grand in a property just gave you a $10,000 write-off every single year for 27 and a half years. Now, I like to talk to people about this because I do it in bigger numbers, right? I have 301 apartment doors. And those 301 apartment doors, I bought 2 buildings in 2025. And between those 2 buildings, I have a $900,000 write-off for just last year for what I'm about to talk to you guys about. I also sold one property, did a 1031 exchange, which was 500,000. So I have $1,400,000 write-off from last year just doing what we're talking about today. So the reality is if you did nothing and all you're doing is buying these properties, you're still getting that write-off every single year for 27 and a half years. Now, if some of you have deeper pockets, you could ask the same question. If I bought a $2.75 million building, I just add a zero. Now what's my write-off every year for 27 and a half years?
100,000.
So some of you guys are writing these things off, right? And you're like, man, I'm not making any money. I'm going to write this stuff down to zero. And then you go to the bank to buy a Honda Civic and they're like, ma'am, sir, you're poor, right? And you're like, well, no, 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 no. I made 200 grand last year, but my CPA, he's a wizard. And they're like, not according to your taxes, right? So this $100,000 write-off, if you only made 100 grand, you're going to pay $0 in taxes now for 27 and a half years, but they will put that 100 grand back into your taxes when you go to get loans. So even though it's a write-off, it doesn't show as a hard write-off like a business expense does, right? Because if you go pay $5,000 in photography for the year, that is a hard business expense. That is $5,000 less in income that you don't get to show. But if you had $100,000 in write-offs for the income that was left over and you paid no taxes, when you go to buy a house, when you go to buy your next rental, when you go buy a car and they say, well, give me your tax returns, they're going to factor that $100,000 back into your income, even though you didn't pay taxes on it. But this is where it gets exciting because you're going to get this write-off no matter what. So all of you as realtors should be buying deals. And if you're not buying on your own, you should be doing stuff like giving me money and then letting me go buy the deals with it. And that's what I do for a lot of these people, right? That are like, hey, I don't want to manage and find the deal and do this. I just want to write a check and get the benefit. And that's totally fine for a lot of you guys to be able to do as well. But now we get into what's called bonus depreciation and cost segregation. So I've got a guy that does it with just pictures if it's just single family houses for like 900 bucks. So it's really, really cheap to do if you're doing it on your homes. If you're doing it on a bigger apartment building, like most of my buildings are 50 to 100 units, it cost me about 6 to 8 grand to do a cost seg study. And what this study does is they send some engineers in to walk the property and take pictures and put together a report. And they're going to look at every single thing that's in that building that's going to depreciate faster than 27 and a half years. So what qualifies? HVAC units, carpet, lighting, roofs, windows, wear items, right? Water heaters. So anything that you know you're going to have to replace, they put into this report and then they give it to you. Now, what they're shooting for typically is 30 to 40% of the building's overall value. So you go out and you buy a $300,000 house. You know you're going to get a $10,000 write-off every single year for just buying that house. If you do that 1 or 2 times a year and you do that for 5 or 6 years, you're doing pretty good. You're already out about 100 grand in taxes. And that's a fine strategy. But if you do this cost seg study, you spend 900 bucks on this $300,000 house, they're going to go in and they're going to take about a third of that. So a third of a $300,000 house is what? It's 100 grand, right? On year one, what would normally happen is if you didn't take what's called the bonus, you would now break that 100 grand up and they would let you speed depreciate it. They'll let you take it over a 5, 7, or 10-year period rather than waiting the 27 and a half years. So you still get the other 2/3 for the 27 and a half years, but now you're going to speed depreciate that 100 grand over a 5, 7, 10-year period. But here's the beauty. Now that bonus depreciation is back and the big beautiful bill is passed, now you can choose to take that $100,000 on year one, which means let's do some simple math here, guys. If you buy a $300,000 house, well, I'll get to your question. What's the difference? Hold on. Let's look at the question before I do my math. What's the difference for you with the 27-year 100 bonus depreciation versus commercial at 39 years? Don't you fall into the 39 years since it would be considered commercial being multifamily? Multifamily actually still falls into the 27 and a half. Even though it is a commercial building, they still key it as residential housing for some reason. But if I was to pivot over and do like self-storage, or if I was to do an office building or a medical complex or a warehouse, then you're exactly right, Jackson. It would go to a 39-year depreciation, but the bonus would be the same. I could still do my cost segregation study. I would still grab my third and then the third of value, and then I would still take that third up front. And then the 2/3 would be left for the next 39 years to break down in addition. So hopefully that answers your question. So now let's do some simple math, guys. You've got a 60, 70,000, $50,000 tax liability. Okay. That's what you're going to owe the government next year. Instead of giving them that 50 or 60,000 bucks, we're going to buy a $300,000 house. That $300,000 house, how much do you have to put down on it? Y'all are realtors. These are easy questions. You can unmute a chat.
20%.
20%, right? You got to put 20% down because you're not going to live in it. You're buying an investment, right? So you're going to put 20% down. 20% down is, like Kelly said in the chat, $60,000, right? There's your tax liability. So you put that money down. Now, you have a rental property that you now own. So let's do some simple math. The first thing I'm going to do is I'm going to bonus depreciate it. So I'm going to take a $100,000 write-off. How much in taxes does that $100,000 write-off save me? Now, I know this is a little state specific, But if you're self-employed, we all still have a 16% self-employment tax. We still got our 16% federal. And depending on your state, that's going to add some. And then obviously you're running through your tax brackets. So overall, what do you think realistically it's going to save in taxes percentage wise? Just a rough number. There's not really a right answer to this because you guys are all over the place. But what do you think? $100,000 write-off, what do I save?
50%.
Yeah, I mean, whoever said 15, 15 is way low. Remember, you're at, yeah, yeah, you're about 40 to 50%, right? Because again, remember, 16% is the federal tax at like $1. And then we're self-employed people. So at self-employed, that's another 16% because you pay your social Medicare FICA, they pay, you know what I mean? You're paying for you and your company's paying for both sides, right? If you're even if you're an S corp, right? Even if you set yourself up as an employee, it doesn't really matter. And then you have your state. Mine's 6. California is like 15. But that's again the base bracket. So yeah, you're gonna save about 50% if they were to just tax you fully. That's $50,000 of your $60,000 liability that you just made back immediately for the purchase of that home on year one. Now, hopefully, you didn't buy a bad property because you wouldn't buy a property that's not going to make you money. So the reality is, how much cash on cash do you want to make on your money? What do you think?
How much should you make?
That's a good question. I'm glad you asked that. So when I structure my apartment deals for people, I do an 8% preferred return for them. And that's the preferred. So like I don't even look at a deal unless I'm gonna make them at least the 8%, right? But then we are trying to get above the 8. It's just what happens is once I pay them their 8, I get to take 25% off the top after that, but then everything else still trickles down to them. Really what I try to shoot for, even though the preferred is 8, I try to get at least a 10% cash on cash for our investors. And some of our buildings do better. I bought a building back in June. They're going to make like 13, 14% cash on cash annually. Now my cash is higher because I take a management fee, I take a waterfall, I take everything else. So I'm going to make this year I'll make 26% on one of the buildings that I own. But let's just say like, hey, we'll be a little conservative. We'll say I'm gonna try to get 12% cash on cash, right? Remember, I put 60 grand down. So that's $7,200 that I make in cash for buying that building. So even if I do this right at the beginning of the year, whenever I have to structure it, right, I save 50,000 in taxes immediately, and then I'm going to make another $7,200. So now I'm at $57,200. Keep in mind, we still got a loan, guys. So the reality is we also had a pay down on the mortgage. Let's just put that at about 3 grand, right? Now we're at $60,000, which is what your entire tax liability was. And then keep in mind, do real estate values go up or down? They go up. So the reality is, what's a conservative estimate for how much value that property is going to gain on year one? Conservative. Again, not crazy markets, not 15 to 20%, right? Like we've seen, which is a conservative number. I saw Michelle say 6. Let's go 3. 3%. That's the easiest math for realtors, right? What's 3% of 300,000 bucks? 9 grand, right? So we add that in. On year one, with this strategy, you have wiped your entire tax liability. You've taken 60 grand that you owed the government and you've turned it into $69,200 at the end of the year. What's that return on investment?
Can you believe I brought someone here that's
It's
making me
over
do math?
100%, isn't it?
It's 106.6%.
Okay.
I'm a math guy. I like math because you can't disprove math. You know what I mean? You either know numbers, you don't know numbers. The numbers don't lie. So instead of paying the government $60,000 that they will now go and make infinite returns on because that's all they're doing is investing your money. You keep that money and you just turned your 60 grand into $69,000 in one year. Now, you may come off of mute and say, well, Jared, some of that's equity and some of that's pay down and this and that. And that's fine. But the reality is you did pull some cash back and 50 went directly into the property. So the reality is you still pulled some cash on cash back. You put the 50 into the property. And if you wanted to layer it and get a little more complicated, I don't know if any of you like flip properties or if you're buying rentals and at least fixing them up. But if you want to have just an infinite money glitch, right, where you're just going to print money and not know what to do, you can do the same strategy, but only do them on burrs. Everybody know what a burr is, right? You buy, you renovate, you rent it out, you refinance, you repeat, right? So the reality is we just did this math on like me going out and finding a $300,000 house that's worth $300,000, right? But the reality is if I did this on a house that was worth, I don't know, $250,000, right? Let's say I bought it for 225 and then I put 25,000 into it, 30,000 into it, and now it's worth $300,000. Well, what can I do now? Right? Remember what's one of the R's in the Burr strategy? What's right before repeat?
Refinance.
Refinance. And what are they going to let me pull? They're likely going to let me pull 20, 25% out, right? So if I can pull 20% back out of that deal, what did I just pull out of that deal? 20% of 300,000 is
6,000.
$60,000. So if you ran this on a Burr, then no one could complain about dropping the cash because not only are they not giving it to the government, but you're going to pull that 60,000 back into your pocket, which means you're going to hit your cash flow, you're going to hit your equity pay down, right, on your loan. You're going to have some equity in the property still, right? Because remember, you're still burring it. You're pulling cash back, but you still have the equity. You know what I mean? So the reality is you're pulling cash back, you keep your equity, you have your pay down. Do we care about the rate? Not really. I care about my cash flow. So to me, if a deal works at 7%, it works at 7%, right? But what we've seen in this rate market is that sometimes that can be difficult, right? The rates can ruin the numbers for sure. The rates ruined burrs for a while because prices kept going up, rates kept going up, and it became harder to find properties to run the burr strategy on, right? But nowadays, as long as, again, the cash on cash works, it's fine. And you can do creative things. We're not here to talk about that on this call, but the 57 unit I bought in June, I assumed the loan. So I actually have that loan at a 3.78% interest rate for 7 more years. That building nets me $30,000 a month for me and my investors. The one I bought in January was 7.5 million. That entire deal was structured on owner finance. So the guy I bought it from had owner financed it from the previous person. So we went to that person and said, hey, will you continue to owner finance it for us? And he was like, yeah, it's been going great. And then we gave this guy 2 million bucks, but instead of giving him three, we were like, will you owner finance 1 million and we'll give you 2 million? He was like, okay. So we actually have two owner finance loans on that property, right? That helped us structure the deal and not have to deal with the bank. So there's a million ways to skin this cat. Again, I don't want to necessarily get but so complicated because I don't want y'all to leave this call and be like, man, I can't implement any of this. This was too complicated. I just want you to understand the principles because sometimes people don't want me to teach this because they're like, oh, well, Jared, you make millions of dollars a year. Like this is too complicated for the normal realtor. But it's not because the reality is we just gave you the example on a $60,000 tax liability, which to be fair, if you guys are making at least 150 grand a year, you probably have a $60,000 tax liability, right? Before you do what? Before you write everything off and try to act like you didn't make any money. So what I'm saying is, yeah, still write off the stuff that's a legitimate expense, you know what I mean? But with what's left, whatever that liability is, you can start doing this, whether it's 40 grand, 50 grand, 60 grand. I have deals that I raise for that people will put in $50,000. I normally don't like to take that little money, but sometimes you got to fill a little bit of a gap, right? Oh, I got 150 left, and three people are like, "Hey, we'll go in at 50,000." They still get the depreciation, they still get the bonus study, they still get their cash on cash return on their 50 grand, but they don't have any liability. They don't have any personal guarantees. They don't have to sign on a loan. They don't have to be financeable or bankable or any of that stuff. But If you're making more, if you're somebody on this call that's like, no, I'm making a quarter million a year, half a million a year, $1 million a year, this everything's the same, just add a zero. That's all I did. I just didn't. I bought one 8 unit building, and then I bought 28 single family homes at one time in a package. And then I was like, oh my God, I never want to own single families again. So I sold all 28, and then I bought a 48. And then from that point forward, I bought a 52, I bought a 57, I bought a 60, I built an 84. And so I just went big. I just added zeros, right? And now I'm adding zeros again. And now I'm structuring deals where I'm like, okay, if I can get to the 20 to $30 million purchase territory, now I can run sweat equity and make millions of dollars on one building in 5 or 6 years and not put any dollars in, but I still get all the tax strategy benefits. So no matter where you're at in this process, whether you're just starting out and you're like, man, I don't want to pay the government 10 grand next year, great. You can probably do this in some capacity. And if you burr strategy, you could definitely do this because you could burr with hard money, not have any money, and still refinance some capital back out and still get your cost seg study and still get out of your tiny liability. So there's not anybody on this call that shouldn't be doing this. It's just a matter of at what level you're doing this. Jackson, what's your plan after 7 years when the 3% ends? I don't understand that question, Jackson. When what 3% ends?
Your
You
3% interest. You said you're locked in for
Oh, yeah. Oh, got it. That's a decent question. So just keep in mind on all commercial loans, you're almost never locked for 30 years or 25. You can hypothetically do Fannie Freddie government-backed loans that will last that long, but it's typically not the case. Typically on a commercial loan, you're going to be on a 5, 7, or 10-year term regardless. You'll still keep a 20, 25, or 30-year amortization schedule. But you still have to refi every 5, 7, 10 years. So my goal is actually likely not to refinance unless the building is just such a cash cow that it just would make no sense to sell. The reality is all of my properties are in that 48 to 84 size range. So all of those are buy up properties for me. So I have 300 doors now. Ultimately, at year 5, 7, 4, whenever my refis come due, we look at, okay, if I sell, can we double our capital that we put in 5 to 6 years ago? And if so, then we're going to steamroll that capital and we're going to take that 57 unit, we're going to turn it into 150 units, if that makes sense. And then ultimately, you will end up with what's you're called your legacy properties. You know what I mean? Where you're like, all right, we'll probably never sell these. They're blue chips, they're cash flowing, they're working, and then they just stay with you. Buy till you die, as they say. But the reality is every 5 to 7 years, it's a buy up period. So I'm trying to buy 1 to 3 a year, just fresh. And then, starting in about, I don't know, probably 2, 3 years, we'll start essentially buying up. So we'll still try to buy one or two a year, but we'll also be selling and buying up. And that's part of what I do when I give my numbers to the investors, right? The investors are going to make 8% preferred return annually, hopefully 10 to 12. But then I also give them an overall return. So I show them the exit. Hey, at year 5 or 6, we're likely going to sell. And when we sell, this is what cash is going to come back to you. And this is what it breaks down to at that point. So I then try to get people anywhere from 18 to 30% overall cash on cash return. They call that IRR, internal rate of return. So if you took the 8 that they made every year and then you took the cash lump sum, that's going to add up to what their IRR is each year. And then they have the choice at that point. They can choose to take their money and run. So if they put 250 grand into a deal and in year 6, I give them a $500,000, they can go take that and go to Vegas or buy a Ferrari or buy their house or pay. I don't really care. But most likely what happened is they forgot about that money. And for 5 years, I was sending them checks every quarter. And they're like, well, I don't want this to end. And you're telling me now, if I give you the 500,000 on the buy up, then you're going to double my cash on cash, maybe better. Just keep my money. So that's the reality is that most of these people are going to have to take a tax liability if we sell and they leave me. But if they stay with me, then they get to keep all of their money. It stays with me. Their cash on cash return doubles, and then we move forward and we keep building the portfolio. All right, questions. What do we say to our clients who own income properties free and clear? Is it better for them to take a loan out on one and buy another with financing to avoid taxes? So yeah, keep in mind refinance money cash is never taxed. So I mean, honestly, you can always use your paid off properties as a bank. I never plan on paying off properties personally. It's just not in my blood, I don't think. I mean, once it's paid off and your depreciation schedules have run, you've got no more write-off anymore, right? You're not writing off mortgage interest, you're not writing off mortgage payments, your depreciation's done after 27 and a half years. So this kind of dream of like paying properties off and keeping them forever, that's just not my strategy. And it's not a wrong strategy, right? If somebody has 10 paid off properties free and clear and they're making rental income, the good thing about it is no matter what happens in the economy, if stuff crashes again, if things get tough, if things get tight, right? There's a safety net in there for people. But the conversation I normally have with clients like that is if they have 5 properties that are paid off in cash, they're getting no tax benefits. They're done with everything they get. If I could sell those 5 properties and take $2 million and buy an $8 million property for them, their depreciation schedule resets, their bonus depreciation resets. They've got an $8 million asset now instead of $2 million in assets that are now appreciating, and they have a $6 million loan that's now paying down versus having no loan that's paying down. So, like, if you look at it apples to oranges and you're like, hey, what's the better move? My net worth's going to 10x yours if I leverage a paid off property into more property. So they can pull HELOCs, they can do refinances, or they can sell. And if they sell, then they would just do a 1031, which would also help them avoid the taxes. Because as long as they 1031 exchange it, they will not pay taxes on the sale. I hope that answers the question. Do you have a target purchase price versus real time now value when you hold on? Jackson, come off mute and tell me what you mean by that question.
Like when you're going after a property, you have it's said property, you have a target range on, you're like, it doesn't matter the value of the price of what we buy it at, or do you like, okay, we try to get it undervalue at a certain price when you're doing this. Does that make
So
sense?
yeah. So typically we're looking for is there something that's been under rented, underutilized, poorly managed, maybe something that needs some capital expenses and things like that. And we'll typically raise those CapEx expenses. So the 57 unit I just bought, we escrowed $346,000 in an escrow account at close to go towards making repairs to the building that we knew had to be done. And then we kicked out the manager. We hired a new manager. We started adding in, utility processing fees for each unit on re-up. We started bumping rents. We changed and upgraded a couple units that needed to be upgraded. So we are looking at, it has to be something that we get to add rents to because it could cash flow pretty well. And if we're going to keep it forever, that's okay. But if we're wanting an exit, then we want something that we know that we're going to add value to over the next 5 or 6 years in some way. It doesn't have to be major value, right? Don't think I got to buy a building that's 50 units and I have to renovate all 50 units. It could just be like one of the ones I just bought was a 48 and 32 had been renovated but 16 hadn't. So we bought it. They already had some good places, good units in rent, and we fixed the common area and then we flipped the other 17. So every time someone got out, we'd flip it and we'd update it to how the other units were so that we could bump rents, right? We were turning each unit for like 13, 14 grand. So we looked at it as okay, well, if we can bump rents $400, then really in the next 2 years, we've gotten all of our renovation money back, right, for each unit. And if we hold it for 5 or 6 years, then we've really added probably $2, $3 million in value to that building. So yeah, that's kind of the thing. We're definitely not going to overpay for a property. But sometimes you just buy them and if they cash flow, like the one I just bought, I'm doing a little bit too, like CapEx wise, but it was already like a 10% cash on cash at purchase. So it was already actually a really good deal. And now we're stabilizing and making it even better.
So you're looking at the cash on cash and the fixed and variable cost adjustments versus
Yeah,
just straight up value. Okay,
Yeah,
yeah,
because the reality is that's what the bank's looking at when they finance the deal to me anyways,
yeah.
right? So sometimes we as realtors, especially if we're on the residential world, we think like, oh, I ran the comps and this is what the sales say it's worth, right? But in commercial, it's so different because yeah, something could have sold for whatever cash, but the reality is the bank is going to underwrite that deal and they're going to look at the debt service ratios and all of that stuff. So it's got to fit in line. So what you're seeing now is you see a lot of these commercial guys over the last couple of years that their loans have come due. They were at 3 to 4% interest rates. They're now having to refinance into 6 or 7% interest rates, and it's blowing their profit out of the water, right? It's going away. So now they're selling, and they're trying to sell at maybe a higher price that they think it should be worth, but the rate dictates the value just as much as the numbers do, because that's factoring into all of these things. So we really, one, have to make sure the banks are going to be okay with it, but two, is it making our cash on cash numbers? Because that's what we're promising our investors. So I don't want to go into a building that's going to have a 0% return in year one, telling the investors, hey, we'll just give it 24 months and we'll start paying you. I want something that's going to say, hey, we're going to be able to distribute within 6 months and start paying you, and then the payments are just going to go up after year one.
So
So
your investor is having you find it and do the deal, and then you're basically taking care of the management and renovations and stuff like that, or does the investor take over from there?
the investor has no say in anything. So again, I don't know. What do we have? We run till noon on these. Is that right? Just so I
Yes.
know.
Yeah.
Okay. Okay.
We have about 20
I don't
minutes.
want to, like I said, I don't want to overcomplicate or get too
No,
deep
no,
in.
no. I just like, what
But
does
we
that
can
look
hit
like?
we can hit all that stuff. So I structure them now, and I used to not. I used to just, me and a partner would buy stuff, and we were just partners, and we own it. And we do the stuff, and we make all the decisions. Now that I raise capital just to scale faster, I set them up like syndications, right? And so you have a general partner and you have a limited partner. So anybody that invests with me is an LP. They're a limited partner. They do not have say. They cannot sign on anything. They do not have any bank liability. They are promised their returns that we promise them, and that is it. When we go to sell, we sell. If we want to keep it, we keep it. So the LP has that restriction in place. You know what I mean? We do
But
tell
do
them,
they
hey,
get
this,
the tax benefits or
of
no?
course, yeah, and you have to watch it because some syndicators will actually keep all of the tax benefits for themselves. I don't do that. I spread it out per the ownership of the property. So if somebody owns 20%, then they're going to have a 20% hold on that cost segregation study. And all of that's broken down in our operating agreements, all of that's broken down in our TIC agreements, all of that, like I have exactly who has how much ownership in each LLC. I'm actually, we have an entire course on this that we're selling. I mean, it's a high ticket item. I'm not here to sell it to you today, obviously. So that's not why I don't even really want to mention it. But I say, I'm only telling you this because I think there's so many layers that that's why I'm built the course to be like, hey, if you want to know how to run your TIC agreements, what happens if there's 1031 money involved? What happens with Fannie Mae and Freddie Mac financing? How they run all of their incomes? How do we raise the cat, right? Like I'm going to do all of that stuff and share it with people because I think there's just such a need for it. And even if you don't ever get that complicated, there's such a need for people to just like, guys, just go out and buy some real estate each year. It's crazy to me that people aren't doing it and they're just paying taxes instead. It's like, stop paying taxes, go buy real estate. You are a realtor. Um,
I love
uh,
it.
Fran Lucci from Charlotte. Your contact info is my Instagram is Jared Davis RE. If you want to find me there, and then if you want to DM me, I'm happy to give you my cell and give you stuff. Like I said, I'm happy to give people numbers. I just do so many like public speaking things. I find people text me and they don't give me good contact cards, and then I never talk to them again. I don't know who I'm talking to. So if you can at least just link with me through social media, it will help. And then again, if you want my cell at that point, if you want to text me versus DM, that's totally fine. Somebody else asked, I lost it. Where's
It's
my,
the eightplex for 1.8 with a $1 million owner financing.
hold on one second. I know of a realtor who has a lot of investment properties and he buys at interest only loans. I don't know all the details, but what are your thoughts on this? How does this affect the write-off? He has quite the portfolio. So IO interest only. A lot of people will do it if they have to value add into a building, and a lot of banks will do IO for a term. So you could run like a 7-year term, and for the first 24 months or first 12 months, the bank may do interest only. And what that allows you to do is if you know, hey, we've got to stabilize this a little bit, we've got some vacancies, we've got to fix up some units, you're not having to pay any principal. And on a bigger building, let's say you're a $2 million building or $2 million loans, that'd be a $12,000 monthly mortgage payment, right? If that saves you $3,000 to $4,000 a month in principal, right? That's 36 to $40,000 a year you save. The perk to that is now that gives you money to stabilize, to up rents, to fix the units up. And if it was going to cash flow at all, it's going to add another 36 to $40,000 in cash flow. The downside, if you want to call it a downside, is that you're not paying principal off. So if you hold it and you did an IO term for like 4 years, at the end of that 4 years, you still have the same principal balance, which means if anything shifts, if you haven't value added, if you can't sell it for much more than you paid for it, then it's kind of like doing a VA loan, right? And then not making any principal payments, right? You ever deal with a VA buyer and you're like, well, I bought it 6 months ago. I'm ready to sell. And you're like, sir,
Right.
how this works, right? Like you have realtor fees, you have closing costs, right? So that's the one downside. But I have done interest only on, I mean, I've done 8 buildings now, I think, something like that. And I think I've IO'd on 3 of them, right? Where we got in and said, hey, if we could get 12 months of IO, it'll help us to just turn over and up the cash flow. And we're not as concerned about that principal pay down on year one. We're more concerned on, is the building stable? Are we making money? So I'm all for it if it's done right. Is the payout a passive income? For all of my investors, it's fully passive. They don't do anything. They get a check every quarter or every 6 months, depending on how we do it for each building. Again, they're not looking at the management. They literally do nothing. I email them every quarter and I'm like, this is what it is. This is how everything is going. Here's the good news. If there's any bad news, here's the bad news. Your checks are going out first of the month. That's it. And so for the people that invest with me, they typically are like people that make money and they just need places to put it. And so they're the people that are like, man, I've already got good stock portfolios. I'm maxing my IRA. I've done this. Or people that had investment portfolios that I had sold them, like houses and duplexes and triplexes, that I've now pivoted over because they've realized, man, running this single house or this single duplex sucks because they're having to collect the rent and they're having to do the stuff versus when they give it to me, it is completely passive for them. And honestly, for me, as long as I'm not in a deal, like acquiring, it's pretty passive for me. It's about an hour a month for me, and I'll net, I think, like 350 this year off of apartment doors. So it really is. It's a lot of work on like the acquisition and the structuring and the raising and the analyzing and the underwriting and the banking and all the crap. But once you own it, it's for me, it's pretty easy. Would you buy an eightplex for 1.8 with 1 million owner financing? So you'd have to put down 800,000 is what it sounds like. Is that correct, Michelle? You can come off mute and talk about the deal. Yeah. So you'd be putting down 800,000. How much in rent is it bringing in right this second per month? Do you know a gross operating income or a net operating income?
Oh, I wish I can look it up.
Yeah, I'll come back to you. You let me know when you have the GOI and the NOI, because and I'll show you how I analyze the deal. We got time. It won't take long. I'll show you exactly what I would do to structure that. Any tips for ground up construction, build to sell? Don't do it. That's my recommendation. Sorry, Crystal. And you can come off mute. We can talk about it. So this is the thing.
Don't do it.
We'll do it.
That's what I do though.
Okay.
And I love doing it. It's my
Okay, all right.
favorite.
So you're already in it. You're already
Yeah.
experienced. It's already good then. So if you already know what you're doing, fantastic. What are you building? Are you building big properties or are you building single families?
Luxury homes, but
Okay.
I like this last one I JV'd with my contractor, and right now he's gonna give me, I don't know, we're coming up with some creative things so yeah, and
hmm
yeah.
I
But
don't look.
it is good margins for like, selling. So you can't really depreciate them, and I think that's more your strategy.
Yeah, well, and the reality is
Depreciation.
if you're just going to sell the house, then the depreciation won't help you that much because what happens is if you sell it immediately, then you're going to get what's called a recapture. And so they're going to come back and they're going to tax you for selling the property that you just did the bonus depreciation on. And FYI, if you don't do a bonus depreciation and you're 10 years in on the property and you sell the property and you don't 1031, it's not just the tax liability on the gains, but they're also going to recapture that 10 years that you wrote off. So that's why we never sell and take money. You 1031. You 1031, you refinance. You buy till you die. You 1031, you refinance. You do not sell. unless it's short-term capital gains like flips and stuff like that, or for you, like you said, you're just building and
But
selling. That's your business. The
mhm.
problem is when you start getting into multifamily and bigger properties to build, if you look at the numbers for holding, there's typically no profit in new construction. I know because I know every developer in town that builds new construction. I know their projects. I know what's happening. I've seen their slide decks. They call me because they know what I do, right? So I've had the opportunity to buy into three new construction projects in Richmond in the last probably 12 months. I passed on every one because when you look at their slide decks, year one is 0% return. Year two is like 0 to 2% return. By year 3 and 4, maybe you're making 4%, right? The problem is rates have gotten high and construction is so expensive now that to make the deals work, I'm not saying that it's not possible in certain parts of the country. I see you're in Tahoe, so I'm guessing it's definitely not possible uh, for where you're at. Maybe Reno. I don't know. I know for most new construction deals, it's a long-term play. The guys that get into that game, if they're holding on to them, they're typically like, I've made my money, I've got cash flow, I've got wealth. I like a building that I don't have to think about fixing up because it's brand new and I'm just gonna hold it. And in 15 years, it's gonna be making money and I'll give it to my kids, I'll give it to my family. Like
Yeah, we're
then
not holding any of it.
I know.
We're building to sell.
So then the flip side of that is now that I've prefaced the fact that just owning and buying new construction is very hard to cash flow and makes very little sense.
Mhm.
The hard part is these guys that are building to hold, they have the equity in it and they're not able to cash flow. So my problem comes in that if you're building like a multifamily to sell, are the numbers going to be good enough for these people to want to buy it for what you're going to have to sell it for to make the money? I'm not saying it's not possible. You know what I mean? There are hedge funds, there are these big REITs that will come in and they'll buy a 20 million, $30 million building that's brand new.
We're
And
doing mostly single family though. It's single family homes
I
because
have not, I mean, I have no problem with it if that's what you're doing. If you're just a single family builder, right? Are you building specs? Is that the main thing? You're just
that's the
spec.
thing.
As long as your numbers are working, I mean, the tips, I don't really have much tips if you're
But
already doing it.
taxes for like basically just 1031 it, and that's kind of there's no depreciation.
But
So,
but even then, you can't 1031 unless you hold for a year. So the reality is, if you're
well, if you're
selling,
holding, it takes a year to build. So, I mean, you're
yeah,
holding
have
for
you
a
have
year.
you have you asked your CPA if the building time counts
No, I
when
was the one who said I haven't filed taxes yet, so that was me.
Gotcha. Okay. So, I mean, so my question would be if I buy a lot and I start building a house, right? And then the house takes a year to build and sell, does that count as a year, even though the house didn't exist until 3 months ago, right? That's a
Right.
CPA question for sure. And then if they say, well, yeah, you've technically owned the address and the government's not going to check into it, then sure, you could. But just keep in mind, once you start doing your 1031s, if you guys have ever done them before, it's a 45-day period to identify the next properties. So you only have 45 days. So you really want to know that you've got another project lined up to 1031 into. Um, I would sooner recommend, we got 8 minutes. Yeah, we're good. I would sooner recommend running it through like a Roth self-directed IRA to do. Like, how do you finance your properties?
Cash, and then we do like builder finance for the build.
So what I would talk to a smart CPA that knows self-directed IRAs. And I would ask them if do you have a Roth IRA that's self-directed right now?
No, and I'm getting ready to get like a payout, so I'm like, I don't really know what to do with it. Like, I
That
want to do another project, but
that I can't help you with for sure because some it's already structured. But on a self-directed Roth IRA, if you're pulling the builder financing, the question you're going to ask your CPA is, can I pull the builder financing for the rest and just put what's in my Roth IRA in? And you may make too much money to do a Roth, but you may be able to backdoor a Roth. The flip side is if you can't do a Roth, you can also do self-directed normal IRAs and 401ks. So you'd have to talk to them about the benefits. I love the idea of the Roth because once you go to finally start pulling that capital in retirement, it's no longer taxable. It for people that are flipping houses, I think it's one of the best things that they can do because you could fund a Roth your $7,000 for the year and then find your flip and do all hard money other than the 7 grand. And they allow this, which means the 7 grand comes out because you just have to fund something. You fund the 7 grand, you flip the house. If you make 50 grand, 57,000 goes back in your Roth on deal one. So for
Wow.
the average person, they put 7 grand in a Roth, and then what do? They buy the S&P 500 index fund, right? And then in 12 months, they're like, yay, my 7 grand is now $7,600, right? And now that's the process for 40 years until they get to retirement. With this, you could literally flip 3 houses and take 7 grand and turn it into 150 in a year. And it would be completely tax free because it jumps right back into the account tax free. And then if you started buying buildings and properties to hold, right? And then you paid them down, you don't get the bonus and you don't get the write off because it's in the Roth. But whenever you start taking that in retirement, all of those rent payments every month, all of that cash flow, it's tax free. It comes straight out tax free. If you sell that portfolio in retirement for $10 million, it's all tax free. That's an entire other hour-long class that we could do at some point. But that would be my new construction tip. If I was going to build new and sell, I would try to structure it in a self-directed IRA if I was just trying to avoid the taxes. And even if you had to live on some of the money, you could always just do like one a year like that, and it would steamroll that account for sure.
That makes sense. I kind of did hear some of that language before, so I'll look into that. Thank you.
Yeah. What if you're
Michelle
renting?
has the details of her 1.8.
Oh, yeah. All right, come off. All right, what's my GOI and what's my NOI?
Your GOI is, what is the GOI? The gross
Gross. What's my
scheduled?
gross operating income?
Gross operating. Well, the net operating is 99. The gross scheduled income. Oh, operating. I don't see the operating.
What's the rent roll? The rent roll. Like, what's the total rent each month?
At 13,825.
13,820.
It's a 5% cap rate,
Yeah, that's low. Where is it at?
Seattle.
Yeah, I don't love it.
Don't
Hold
love
on.
it.
Well, your purchase price would, I mean, they want 1.8, you said?
They
I,
well, yes, and your total expenses are 55,776.
okay. So you're netting, like you said, you're netting the 99 or whatever. You said well, that math doesn't work. It'd be 100 and something. Are you netting 100 and something? You net 99.
It says your total net operating income is 99.
Okay, so
Gross
you're
adjusted income is 154.
so 154. Okay.
Gross scheduled income is 166, 960.
So they've got some vacancies or some delinquencies or something like that, or what it is. So really the 154 is what you'd want to go on then, not the projected. So if you're at 154, I mean the reality is you're probably more like a 1.6 purchase price, to be honest. Maybe 1.65, 1.7, but to me, I think 1.8 is probably steep on the purchase price. The next thing you figure out is okay, is it a good investment in general? Because you would be putting down 800,000, right? Anything else, closing costs, any capex you have to put in, or you think it's 800 even?
Right? No, everything else on top.
What else on top in addition to the 800 do you think you'd have?
Closing costs. Um,
Any expenses that you have to put into the building?
I don't know. Nobody's been in it yet.
All right. Well, then if we just leave it at 800,000, you're making 12.3% cash on cash based on that number, which is pretty good from a cash on cash return, I guess. But you're also putting down, I mean, 50%, right? Which the reality is if you're willing to put down 50% on a building, um, you should be able to get those numbers all day. You know what I mean? Because typically, if you look at like 20% down with bank financing, a lot of times the numbers may not work that well. And so, what does the bank try to sell you on? Well, they're like, well, if you just put down 35% instead of 20, now it starts making more money because there's less leverage on it, right? So, in this sense, you're putting down 50%. So, you would expect the numbers to be pretty decent. I think if you could push them down to like a 1.6 purchase price, it makes much more sense. And then keep in mind, you're putting down over 50% at that point. And so you're going to have a smaller, um, what do you call it? You're going to have a smaller cost seg basis because 800 grand could really go out and buy you a $4 million property, right? Which would give you $1 million write off on year one. Or you're really only going to take about a $600,000 write off in year one based on that purchase. So from a cost seg study, I would be buying more leverage, if that makes sense.
More doors.
Yeah, I would at 800 grand for sure, even if you had to raise a little. What if your rental was previously your personal home and you bought one new? Talk to your CPA. Don't talk to me on that one. There are some things that you can do to convert over and do some write-offs, but I think because you currently owned it, you're probably not able to go back and cost seg study because it was a retroactive law back to July. So it's everything from like 2025 on. Let me see. That's you. Got deets. Let's see. The lot purchase or cert. I don't know what y'all are talking about on that one. I have a self-directed Roth IRA too. Would love a class on that. Happy to help on that. I would love to attempt. Happy to help on that. Any states you'd stay away from. I like cash flowing states. So the reality is like most of my stuff's in Ohio, right? Like if you were like, how's Ohio? I'd be like, I don't know. I never want to go, right? But the reality, sorry if some of y'all live in Ohio, but no desire, right? I have no desire to go hang out in Ohio. I've been twice since I bought all these buildings up there. I'm almost never there. And then I have some stuff in Norfolk, Virginia. I like Hampton Roads. I like Lexington, Kentucky, and some of the Kentucky areas. I've been looking at like kind of just the Midwest right now, as far as like some of these places that are just blue collar towns that crime's not too bad, cash flow is okay. I don't want government housing and I don't want luxury housing, right? I want that middle ground housing that's like I'm a plumber and I don't have enough to go buy a house, but I take care of my stuff and I just need a decent place to live, right? That's kind of our buy box. So Ohio's good, parts of Virginia are good. I avoid states that are heavy to the tenant. Like I would never buy in California. I'm not buying in, New York. I'm not buying places where, I have no rights at all on my property. So I avoid stuff like that. But I mean, even West Virginia in certain areas, Kentucky, Virginia, Ohio. I'm looking at Kansas a little right now, Minneapolis, Minnesota, all that stuff.
That's awesome, you guys. If you have more questions for him, find him on Instagram.
Yeah,
We
sorry,
do
we're
have
right
to.
now. Yeah.
You are good. You are good. I literally could listen to you for hours because this stuff is so crazy to me. And it's funny, I've been a realtor for 20 years. You'd think I would know this stuff, but like I just help people buy houses. So you do things a different way, and I love your brain. So thank you for sharing your brain with us today.
No,
We're gonna hop into the VIP room where we work on things together. Jared, I have people wanting you to come back for Roth IRA. So maybe in April, we have some openings in April. That would be a super fun class. I feel like everybody really needs that, especially if they're making money, right? And we need places to put it. So thank you so much. And you guys, thank you for coming. I will see you next week. Have an amazing week, or I will see you in VIP in just a moment.
thank you
Hi,
guys.
Jared. Thank you so much.
Bye.
Bye.
Awesome.
See you in
Thank you.
Cabo.
Awesome.
I'll talk about this in Cabo. That's what I'm talking about in
Oh,
Cabo.
perfect. All
I'll be
right.
on stage on this.